All right, let's officially get started here. Um, my name is Jim Cagnina with Infinity Futures, and yeah, I know it's a PowerPoint, but I'm going to be mixing it back and forth with charts and trading ladders and stuff like that, so don't freak out. I do want to do a, no, I didn't want to do that. I want to do a different view here, so hang tight. Let's see how that works. No, bear with me here a second. We're going to just stick with this view. Let me go to this top. All right, thanks for being here. Appreciate you taking the busy time out of your schedule to be here with me. My name is Jim Cagnina. I've been with Infinity Futures since 2001. Prior to that, I did a whole bunch of stuff. Did a lot of consulting to the futures industry on the website development side. Prior to that, I initially became engaged in the futures trading business in the early 80s. Not sure what year, might have been 81, might have been 82. My summer job in college was a runner at the Chicago Board of Trade in the U.S. Treasury bond, 30-year Treasury bond pit. And that's how I was introduced to this market. Obviously, a lot has changed from the pit to electronic, but along the way, I have learned a lot. And Infinity Futures was actually established in 1995, as you see on your screen, and made an early transition, or was early adopters to the online trading phenomenon, and offered online trading services early on, late 90s, and haven't looked back. Thanks, Pat. I appreciate that. So let's go ahead through this presentation here. Hopefully everybody can see it okay. And I know you're going to ask, yes, this will be recorded and will be posted on our YouTube channel, and I'll show you how to get to the YouTube channel in a little while. So let's get into it here. We already talked about this. We're going to keep moving on. Let's talk about risk. We're going to talk a lot about risk is important today because we're talking about relative risk as we talk about the transition from traditional types of trading and investing to the futures markets. That's really the focus of today. And here's a typical risk disclaimer you see on our site and emails and other people's websites. Futures trading, options on futures, and retail off-exchange foreign currency transactions. That means Forex or cash Forex. Involves substantial risk of loss, is not suitable for all investors. Oftentimes in futures trading, you have a high combination of volatility and leverage. And although that can be an equation for opportunity, it's also an equation for risk. So be careful, only fund your futures trading account with risk capital. My personal definition is money I could afford to lose. It doesn't change my lifestyle or lengthen my retirement horizon or really overly anger Mrs. Cagnina. Now, I say that kind of tongue in cheek, but life has got a lot of stress in it. And under stress, sometimes you make bad decisions. So be careful there. If you're not sure where you fit on the futures trading curve of things, risk capital curve of things, contact your Infinity representative here. Everybody has one. You don't have to have an account here to have one. And most of the reps here have extensive experience, actually all of them do, with respect to online trading and the futures markets. NFA members, CFTC registered, and all that stuff. So if you don't know who your customer service rep is, just let me know and I'll get you their contact information. Or if you want to talk to me directly, everybody's welcome to do that at any time. I'm here almost every day, all day. So that's a little bit about risk. Let's talk about the different kinds of futures trading profiles. A lot of people seem to think that, well, you can only day trading is the only way. That's what futures markets are there for. But that's not entirely true. And I would categorize different profiles this way: day trading, opening and closing positions the same day. Swing trading, opening a position and closing it maybe that day, maybe the next day, maybe within a week. A shorter investment horizon for a swing trade. Position trade is you want to hold on to a position for a long period of time. Spread trading would be trading two instruments against each other, taking into account their natural relationship between the two. And you can see in spread trading, my thought process kind of ended, but I'm going to add this little tidbit. A good spread trade, oops, that's going to be too far, so I'm just going to leave it at Russell. S&P 500 and the Russell 2000. Maybe going short the S&P, going long the Russell to take advantage of the widening that we've seen over the summer in this particular spread. So that's another type of profile that I would suggest. And then managed accounts. These are professionally managed third-party, regulated entities like commodity trading advisors who would manage your individual account for you in a block mechanism that they manage everybody else's accounts for them. And then lastly, we've heard a lot about this in the news, and we see this all over the place, algo systems or automated trading systems where you hook up your account and you get a black box or gray box type of trade automatically populating into your account. So those are the 1, 2, 3, 4, 5, 6 different categories that I would think, that I think about when I think about futures trading. And today we're going to focus on day trading, really. But I'll answer any questions about any of these categories. But today's focus is on day trading. So let's move along here a little bit quickly. Let's talk about day trade margins. That's the crux of the matter when you're comparing trading different instruments, whether it's equities, stock options, cash forex, ETFs, or futures on options. And I have a definition there, and I'll read it out loud. Day trade margins can be in place for positions that are open and closed the same trading session. In other words, the day trade margin that's associated with any given market is unique, and that applies to positions that are open and closed in the same trading session. Day trade margins will magnify the risk per capital of the trade. This is the risky part, right? The less capital you have in an account that you apply to notional value of a trade, the percent gain or loss is magnified. So use day trade margins gingerly and wisely. Day trade margins are also subject to change based on market conditions. They change all the time, and they're based on volatility mostly. Traders' experience and account size should be taken into consideration when determining day trade margins. So where we're going with this is firms like Infinity and other futures trading firms have some flexibility in assigning and creating and applying day trade margins. And we'll talk more in detail about that in a second, actually right now. So if you think about margins that are set by the exchange or performance bond requirements that are set by the exchange on the future side, initial margin is the amount of money you need to have in your account to establish and hold a position past the close on any given session. So if your intention, oops, I don't know what that is. If your intention is to open a position and hold it, whether short or long, then you're going to have a specific margin associated with that particular trade that's established by the exchange. And we're going to talk about the CME Group exchange a lot today. So that's not negotiable. That's something that they determine based on their span margining risk procedures algorithms that they have, and they're widely published. They do change from time to time, but usually not intraday, right? They change based on what's happening in the markets. So that's kind of number one. If you intend to hold something over, or if you accidentally hold something overnight, then these margins kick in to place, and you have to have that amount of money in your account to do that. Day trade margins, in many cases, are set by the FCM or the brokerage firm at a lower rate, at a smaller amount, and these are in place for positions open, close, same trading day. So you'll see day trading margins vary from firm to firm. And Infinity does provide flexible day trade margins, and we like to have conversations with customers to talk about what that means and what kind of flexibility we could offer and what to expect in the pitfalls of those. The big transition to consider here also when trading futures is the ease in and we're going to pull up a trading later and I'll show you, but the ease of not only buying a futures contract and holding it for a period of time, whether it's a second or a minute or 5 minutes or 7 hours, and then selling it, you could do the opposite. You could sell one immediately and hold it in the anticipation that the price will go down and you'll be able to buy it later, and the difference, of course, would be your gross profit. So one of the important, and that day trading margin apply is the same whether you're going long or whether you're going short. There's not a different amount based on whether you're going long or going short. Just to back up a little bit, is when I talk about margins, it's how much capital you have in your account is your margin. And on the equity side, there's a couple different types of accounts you could have. You could have a cash account. You could have a margin account. On the future side, you have an account, and it could be a margin account or a cash account, depending on your point of view. It just so happens that some of the contracts are so big, you have to have a lot of cash in your cash account for it to be a cash account. So most people trade on a margin basis anyway. Let's talk about the pattern day trade rule. This is one of the big reasons why people call me and say, hey, I want to be able to trade more effectively. I want to be able to trade more efficiently. Pattern day trade margin, it's a FINRA designation, which basically puts some barriers between the trader and the in your account and your capital and your money and the money that you want to trade. And this rule has been around for a long time, and some of it's starting to change, but it kind of slows your roll if you don't have if you don't qualify as a pattern day trader. Then it's really hard to have multiple stock trades in any given day. So the futures market is a great way around that. And so there's no pattern day trade rule really with the futures markets. And we like to think in terms of capital efficiency, right? So a pattern day trader has to have 25,000 in their account or more in order to be qualified under that designation. On the future side, we have accounts funded as low as 3,000 that still have access to similar markets, and I would argue more efficient and leading markets than you do on the equity side. And there's no minimum or maximum number of day trades that you need to make in order to qualify for the account. You could make 0 in a week, or you could make 400 in a week. That's up to your personal strategy, your personal technique, and opportunities that you identify. So that's a pretty big advantage, and that's probably the number one thing. Hey, I don't want to throw $25,000 in an account, sort through a whole bunch of trade ideas, and then have to borrow money because I want to be leveraged. And as opposed to, hey, I want to fund an account and I want to trade. How much do I need to trade this contract? And I just touched on you're not borrowing any money to trade futures. You're funding your account with risk capital, money that you have targeted as risk capital, and there's no borrowing. On the ETF side, maybe you are. Management fees on the ETF side could be 20 basis points. A lot of folks don't realize that, and they don't realize, well, there's a hidden cost to business here. On the future side, of course, if for self-directed accounts, which is what we're talking about, there's no management fee. The only time you're charged is when you make a transaction. You're not charged for limit orders. You're not charged for things that didn't get filled. It's transaction-based and generally cheaper. Let me give an example, too, of this whole idea of capital contributions to a trading account. I'm going to try to compare an E-mini S&P future, which is one of the more popular markets, more volatile, more liquid markets in the futures trading space, with an ETF. And I'm approximating values here. E-mini contract, approximately worth $125,000. Actually, it's As of today, it's 126,350. But in order to standardize this, we'll kind of compare apples to apples. So $125,000 contract, one E-mini S&P contract, let's think about that. Value is $125,000. It's not a small contract. And as of, I don't know, yesterday maybe, the overnight margin was $4,950 per contract to buy one and hold one, or to sell one and hold one. The amount of a day trade margin at Infinity, and remember, day trade, lower the margin, the higher the risk, is as low as $500 per contract. So in theory, let's say we took the minimum $3,000 account and we wanted to do 6 contracts, we would be able to do that. I'm not an advocate of maxing out on day trade margins whatsoever, but from an example point of view, I think it's important to note that. On the ETF side of things, you have about 500 shares equals $125,000, so we're talking apples to apples, and you need 31,000 at a 4-to-1 leveraged account on the ETF side, 31,000 about, plus interest on the rest of the money that you borrowed per contract equivalent to match. So you have this capital efficiency type of idea associated with the futures markets. Settlement's another thing. We used to have 3-day settlement called T3 on the equity side. As of September 5th, it's now T2. Trade date plus 2 days before your trade settles, and you're able to go ahead then and have your capital freed up to make another trade. There's a quote from Motley Fool which shows, I didn't make this up. This is somebody else's observation as well, is your capital can be held up depending on the category of equity trader you are because of the T2 rule. On the future side of things, when you liquidate a position, you're able to immediately, there's no T2, it's T equals 0. I mean, you're able to go ahead and make another trade immediately if you so choose. You don't have to wait for some sort of, I'm not going to call it fake period of time, but some kind of period of time for you to get permission to trade again. And this applies to both day trading and position trading. Sam is a little late today. No worries, Sam. Thanks for coming. So the benefit's clear. You don't have to wait. If you see another opportunity, you could go ahead and take that opportunity. Reporting, it's a lot simpler on the future side for tax purposes. You're getting a 1099 at the end of the year with your profit or your loss. And your accountant takes that and does your taxes. Don't have Schedule D. You're not tracking all your trades for accounting purposes. You should track your trades for performance purposes. That's a whole different story. But for Schedule D, nah. On the future side, you get a 60-40 long-term capital gains, short-term capital gains tax treatment, and an average kind of blend is around 28% or so. But that's kind of, it could be extreme either way. ETFs, it's ordinary income. That's how you're taxed. No time decay. This is for our option trader guys out there. The Greeks and the time decay and all that stuff could complicate the trade idea. It could affect the timing of your trade idea in a way that you didn't expect and you couldn't calculate. On the futures trading side of things, your opinion, once you express your opinion, then the market in real time shows you whether or not you're right on a continuous time basis. There's no decay. The contract is still in effect. And most contracts are good for between 90 days. Every quarter they roll over. We'll talk about rollover later. And 30 days. So there's a time horizon on how long the contract is good for. And it's discrete. It's defined. Everybody knows it. And the worst case scenario is you roll it over into the next contract month. Not a lot of downside there. Centralized marketplace. This is important to me, and this is, I think, what I've witnessed in my transition from 1980s floor guy to, 2017 electronic guy. And the amount of games and the amount of moogie foogie, and moogie foogie is a word that I just made up, I think, is abated with electronic markets. You have, in the future side of things, you have centralized exchange, no ambiguous order routing. We're not your broker's not sending something to one of 4 or 5 different places or taking it themselves. These are routed to one exchange, and that exchange is transparent. In other words, you could see everybody's bid and offer and how it changes and how it's dynamic in real time. This is a trading ladder, the E-mini S&P. I know many of you guys here are familiar with it, but we have some new folks in here also that are not. So I wanted to bring this up, and this is what everybody sees. This is the information that everybody gets, and which means it's transparent. You see bids and offers, 10 ticks deep, and last traded prices, which is the dark blue horizontal rectangle in the middle. My guess is, in many regular equity options, ETF systems, you don't see this. You don't get this transparency. You don't get this feel for the market, and you don't get this immediate movement. First, it's a fair exchange, first in, first out. It doesn't matter if Goldman Sachs comes in after you; they don't jump your place in line. When your trade goes to the exchange, you're in line, you're in order. It's first come, first serve. Doesn't matter how big or small you are. AJ asks, is there any canceling orders? I'm going to take this question. This is a good time for this. To buy or sell. Is there any cancellation fee on canceling orders? No. AJ, the only time you're going to get charged is if you're filled. If you buy one or you sell one, it doesn't matter if it's a market order. Doesn't matter if you're filled on a limit order. It doesn't matter if you're filled on a stop order. Once you get a fill, a transaction occurs in your account, then that's when you get charged. To cancel an order, there's no, and to be honest, most people on the future side have abandoned the practice of charging for canceled orders many, many years ago. So it's just not a factor. It's not something to worry about. Anyway, back to the green PowerPoint. Fair exchange, first in, first out. Trading 23 hours a day. Sunday night we start, we go all the way through Friday afternoon. And we'll talk a little bit more about that in a second. Brokers not compensated by the exchange's order flows. And a lot of people are going to be like, what? Some people get compensated for order flow? Yeah. Not in the futures market traditionally, but in other markets, the answer is yeah. Money gets kicked back to the broker for routing an order a certain way. That doesn't happen here. We're talking about fairness. We're talking about transparency. We're talking about centralized exchange. We're talking about fills that happen in as low as milliseconds. It's a different type of animal, different type of trading. Tio, hold that thought. We're going to talk more in depth about the trading ladder in more detail, but the answer is yes. All right, let's go over to the next one, volume. This is kind of important. Even when you compare the E-mini S&P to the SPDR ETF, I would argue that the notional value and the volume and liquidity are way superior in the E-mini S&P product. And what that means is when you have liquidity and high volume, you have tighter bid-ask spreads. And a bid-ask spread is simply the difference between the highest bid and the lowest offer. And here it's as tight as possible. It's one tick or one price increment. It can't get any tighter, which means your transaction costs could be smaller. I mean, if it was a 5 tick wide entry to the market, of course, your transaction costs would be higher. And this extreme amount of volume, you could see there's bids and offers in the thousands, helps with price stability, intraday price stability. Because in order for a market to, I don't know, act, and I call it the popcorn effect, bounce around in an unreasonable manner because the bids and offers aren't balanced, or because the bids or offers are smaller, the more volume creates a more stable trading environment. Now, keep in mind, most of the stuff I'm saying, a lot of the stuff I'm saying today is going to be based on my opinion. I'm a fan of these markets. I can't imagine why everybody doesn't trade them instead of day trading anything else. It makes no sense to me in my mind. So I'm passionate about it and I'm opinionated about it, but I've been doing it a long time. So I just wanted to put that out there for you. Options traders have seen, a lot of option sellers on the equity side. You'll see a split bid and ask. The bid and ask aren't close, and you got to put your order in the middle, and you still don't get filled. So that's another thing to think about. All right, I said we're going to talk about this again, and it's really important. It's trading 23 hours per day, right? So there's usually an hour break between 4 and 5 p.m. Chicago time for, I don't know, system maintenance, whatever the CME does. That hour, there's a break. Can't make any trades, the market's closed. And then after that hour, it opens up again for the next day. And that, we all know global events happen all the time. You might actually live in Asia, you might live in Europe, you might live in South, you could live in different time zones and still have access to the exact same E-mini S&P 500 market that I have access to being in Chicago. That's kind of number one. And obviously vice versa is true, but you could also take advantage of, there's a lot of trade opportunities and trade ideas that happen at 1 o'clock, 2 o'clock in the morning Chicago time when Europe opens. You got the DAX opening up, you got the Euro Stoxx 50, you got London opening up, you got a lot of good stuff, a lot of activity, a lot of ideas. So other than the fact that global events could happen at any time, you also have traditional types of investment-related activities that happen internationally related to things like interest rates and CPI numbers and other economic indicators that are coming out of Japan and coming out of London and all sorts of places. So that's another reason to have these markets open. Not only that, though, maybe you're not up and you just want to put a stop in to protect yourself in the event that there is some sort of, and I hate to use the word black swan, but some kind of extraordinary event that causes price dislocation, and you could protect yourself. So here's a notion. You don't have to have a special account to have a night trading ability when you could have one of these types of accounts. Day trade margins would apply to the trader who's trading at night. Think about that as a benefit. All right, let's talk about asset classes. There's a whole bunch of stuff here that you could trade that a lot of folks don't realize. You have stock index future, and we're going to dig into all of these kind of quickly, but we're going to dig into all of these stock index futures, interest rate futures, energy futures, currency futures, metals futures, and agricultural futures. Those are kind of the 6 categories of different asset classes. And there's other ones, there's other exotic ones that we're not going to talk about that aren't really retail markets that are out there. Emission credits, stuff like that, we're going to kind of stay away from today because that's not really those markets aren't good for day trading. Index stock futures, here's a few of them. E-mini S&P, which is large cap stocks, NASDAQ futures, which tracks tech stocks, Dow Jones futures, which everybody's aware of, and it's all over the television screen just about 24 hours a day. Blue chip stocks here in the U.S. and Russell 2000 small cap. I'm not even getting into the Eurex equity, stock equity indexes, which are also very good to look at. These are CME Group equity. And on the right, there's a little chart here. It's got ticker symbol. I just I cut and paste a snapshot of ticker symbols so you get an idea. Interest rate futures. Ultra Treasury bonds, relatively new. 30-year U.S. Treasury bonds, my favorite. That's what I grew up on. Once upon a time was the most traded contract at the Chicago Board of Trade. Still very liquid. 10-year U.S. Treasury notes, the most liquid market we're going to encounter today is the 10-year U.S. Treasury note. 5-year notes, 2-year notes. All of these markets have super low exchange fees, and all of these markets are liquid and react to a couple of different factors. Of course, they react to interest rate policy here in the U.S. They're a flight to quality internationally. The Federal Reserve has a lot to do with it. They track really nicely with other markets. So the correlation with bonds and gold, correlation or the maybe anti-correlation with bonds and equities. All of these types of things are chartable. You can analyze them. It could help you come up with conclusions on what's going to, how to trade. The Treasury bonds and the Treasury notes themselves could be spread. You can do a knob spread between notes and bonds to take advantage of the yield curve. This is really a picture of the yield curve that we're looking at right now. We don't have Fed funds up there, but that would be the other component to it. But yield curve trading is very popular here. So in conjunction with the super low exchange fees, and even if you're speculating, bond markets are great. Interest rate markets are great. Energies, crude oil seems to be more and more popular market. A lot of our customers are interested in it. And in my opinion, crude is very much a supply-driven market. A lot of information. Follow Jack Kemp on Twitter. A lot of information on the crude oil market. A weekly U.S. inventory report that really helps you get a supply picture and potential supply picture on how to trade crude oil. Great market. Natural gas, also a weekly EIA report on natural gas that comes out, I believe, on Thursdays. Heating oil, unleaded gas, and grain futures. Oops, grain futures shouldn't be on the slide. Grain futures should be on the agricultural slide. My bad, but we're not going to correct that right now. Euro currency futures, Euro FX, British pound, Canadian dollar, Swiss franc, Australian dollar, Japanese yen. There's many other ones, New Zealand dollar. These seem to be some of the more liquid ones, Mexican peso. And the difference with currency futures here is you're trading a currency pair on a regulated exchange. It's a lot different than a cash Forex account. It's a lot different than an over-the-counter currency trade that you would make with a cash Forex account. This is one regulated exchange. Nobody's making the market. No one's taking the other side of your trade. The firm's not taking the other side of your trade. CME's not. There's no interest charges. The whole position's over on the future side. There's just a lot of benefits and a lot of fairness issues. No requotes. This particular exchange where these currency futures are traded, these crosses, these currency pairs, whatever you want to call them, is a powerful electronic machine. They're putting out bids and asks on a very reliable, quick basis. This isn't a third-party brokerage firm who has decided to create a dealing desk. So I'm high in the currency futures, something to look at. They trend nicely. Metal futures, gold, silver, copper. Silver is a big boy contract. You should be well funded if you're trading silver. Gold, a lot of folks trade, a lot of retail traders trade, and they have a lot of good theories on that. It moves pretty well. Trend in September is definitely just reversed from bullish to bearish. Copper, also another nice market to consider with its industrial components to it. It has some real supply and demand reasons on why it moves. Agricultural futures. This was what started it all, right? 1876 or whatever started the first futures markets. Corn, soybean futures, soybean oil, soybean meal, wheat. And then live cattle, I'll put that into the agricultural category. This is a unique asset class, and this was what the traditional commodity broker did. This is what we did before the 70s. This is how, you know, a commodity broker and the futures exchanges made their living, and all these other products kind of jumped on the bandwagon and became forefront leaders in their particular industry. I know it's just a fantastic phenomenon, but here's some other markets that you could consider trading. If you're making a transition from a SPDR ETF to an agricultural future, a little bit harder to do. You got to do a little more homework, a little more research on that. Theo, pork bellies is not a market I would put on this list as something to think about. All right, so, and here's the other, it always amazes me when people don't see this and say, wow, this is really, really cool. And I showed the DOM. I'll show the DOM in a second, but it's easy to enter an order. It's easy to modify an order. It's easy to cancel an order. And our trading platform has several tiers of what's called order cancels order, or if you're really old, order cancels other functionality. Bracket trades, multi-target brackets, trailing stops, breakout brackets. And then you could combine those and come up with your own strategy. So this ease and efficiency on a trading ladder and the way that the information is presented to the trader it creates a gateway, in my opinion, to better trading, more efficient trading, smarter trading. And of course, the depth of market 10 ticks deep. And let me pull up the ladder right here. And this is the basic ladder, okay? And you've got the ability to set your contracts sizes based on the size of your account, and then the desired amount that you would like to trade. The prices are in the middle here. That's why it's called the price ladder. The dark blue line across the center there, rectangle, highlights where the market's at, where the last transaction occurred, where the last buyer and seller agreed to a price. Now, obviously, buyers and sellers don't agree to a price. It's matched electronically. You don't know who you're selling to. You don't know who you're buying from. But that shows you, and if you think about it conceptually, this is where the last deal was done. And in day trading and futures trading, this moves around fast depending on what time of day it is. It's 11 o'clock, it's lunchtime, so things are going to be kind of slower now than it would be at the open, that it would be in the pre-open, than it would be in the afternoon, toward the close, that it would be right in front of a Fed number. So there's times in the day when you get ebbs and flows of volatility and price action that occur. But you could see that there's interest in this market. There's thousands of contracts. The notional value of this price ladder, I can't even estimate. You know, 20,000, 30,000 contracts times the price times $50, whatever that is. Someone's got their calculator going right now. 30,000 times 50 times anyway, that's times the price, right? Times 25, 28. That's your notional value of this market right now. It's heavy duty stuff. So, but the ease in which the regular trader could participate is phenomenal. If I wanted to put a limit order in to sell one at 25.30, I just move my mouse to the pink side and click it once. Now I have an order that's, now I'm in a real-time, I'm in a sim environment. So this is a simulated, real-time simulated account. It's not an actual trade that I just sent to the exchange, just so you know. So, and it happens fast, quickly. I mean, blink of an eye, boom. As soon as you see this one here, it means you have a exchange ID that's tagged to your trade. It knows your account. It doesn't actually know your account, but this actual trade is tagged with an exchange ID. You're in their books. You're in line behind 16 other contracts, but you'll notice that 1,663 number here that are waiting to be filled is dynamic, and that number will change as the market approaches it. Now it's 1648. Some people have canceled their order and changed it, or just deleted it, decided they didn't want it. So it's a dynamic number. And as people ahead of you in line cancel their orders, then you get closer up to the front of the line. And the really cool thing is this market cannot possibly trade at 25.30 and a quarter, the next tick up, without giving you a fill. You are blocking this market from going past you. It must give you a fill to get to that next price level. And I guarantee you, you're not going to block the market. So it's fair. It's fair and it's transparent and it's easy. Now let's say I want to move this. I don't want this price anymore. I want to move it down 2 ticks. I want to move it to 25.29. I'm going to click on it once and move it down and click again. I'm at 25.90. I'm sorry, 25.29.50. I just canceled it and replaced that order. I canceled it. I replaced it. Now I'm back in line at a better price, or at a lower price. I don't know if it's better or not, but it's at a lower price. And I have this little green bar here that's showing me, hey, this is a limit order. Green means go. If I want to cancel this order, I'm going to move my mouse on it and right-click it. It's gone. It's canceled. So, you know, the mouse and the screen and the ladder give you the ability to react in an exact and quick manner with your trades. And depending on my strategy, I might have, you know, a strategy that says, okay, every full point, I want to sell one till I'm short 3. That could be a strategy. You could cancel all of those if you don't like that strategy. If you want to place a stop, well, you're going to go, stop. Let's place a stop. You could see it's a smart kind of mouse too, right? So I move it over and it shows, hey, you're going to place a stop, or hey, you're going to place a limit order. So let's go ahead and place a stop at 25.27 even. I've just placed the stop. It's color-coded red, and it tells me that's a stop I have working. Now, I know what some of you guys are thinking. Hey, how could you have a stop? You don't have a position. My position over here is 0. You could enter the futures market on a stop. Let's say you have a breakout strategy. Hey, if the market breaks down past 25.27 and a half, then we're going south, man. But I don't want to sell it until it gets down to that level. Well, then you're going to enter on a stop. So you'd be selling on a stop. And let's say, a whole point later, you want to take profit if you're right. You're going to put a limit order in. So now I'd be selling on a stop at 25.27 and buying at 25.26. So the ladder itself gives you the ability to apply a strategy and a technique that's unique to you. So that's why we didn't sell. Well, I don't want to sell at 28.50 because because maybe I have a trend line that shows a lot of support at 28 even, or 25.27. And it's highly unlikely we're going to break down past that. So if I sell it here, I'm going to lose 4 ticks. Maybe I want to wait for it to break through. It's a breakout strategy. I don't know if it's good or not. I'm just answering your question, why would someone want to do it? Well, because if I just sell it to you, I'm going to sell up here at this price. I don't want to sell at this price. I want to sell at this price. I want to sell at a lower price. I'm not convinced it's a good time to sell up here. I want affirmation. I want someone to break through my resistance level. I understand it's intuitively kind of weird to think about, but that's a strategy. I didn't make it up. So, anyway, all right, so let's keep going here. And we could pull that trading ladder up anytime anybody wants to. Let's see what else we got here. Or we did that. So here's a simple example. I don't think you guys need it. I think you get the gist of it. But if I have a winning trade example and a losing trade example. So in the winning trade example, if you're buying E-mini at 20.5 and you sell it later on at a price of 25.23.5, you've made 3 points, right? The difference between 25.20 and 25.23, 3 points. Which is, and it's $50 a point. So your gross P&L on that is $150. You made $150 on that move per contract. If you have 2 contracts, you would have made $300. If you had 4 contracts, you would have made $600. Alternatively, if you were to buy an E-mini S&P at 25.20.50, and instead of it going up 3 points, it goes down 3 points, to 25.17, and you sell it then, and then you've lost $150, and that's your gross P&L. Now you're also going to subtract, roughly $5 or so on transaction costs, which include, exchange fees, exchange NFA, and commissions. So it's closer to $55, $155. You would lose $155. Here you would only make $145, right? Because this is just gross. That would be your net. That would be your net. So that's a simple kind of trade profile of a trade, I guess. The Infinity AT trading platform, which is unique to us in that our FCM and parent company Transact owns, operates, and maintains this platform, as well as the data feed, their CME ISV. This is what it provides. All the stuff I showed. I haven't shown the charts yet, but I will. The platform is free. When you open an account, I know everyone wants to open an account. I know you're excited about it. I know you're just waiting for me to show you the open account button. I will in a second. Hang tight. And it's free. So the platform isn't free. The charts are almost always free. There's a 10-round turn per month requirement to make it free. Otherwise, it's $19.95 per month or per 30 days, which is still a great value. You don't get these charged for that price in either case. But what a round turn is, let me show you what a round turn is. If I buy one at the market, I'm long one. I'm long one here. I bought one. I'm long. Their nomenclature is long. If I would have sold one, I would have been short, right? That's what we'd say. I'm short. I'm long now, and let's go ahead and just try to scratch the trade. I'm going to put a limit order in to sell at my price. I got filled, and so now I'm flat. That's one round turn. So if you do 10 of those in 30 days, charts are free. Otherwise, $19.95, which is, in my opinion, once you see the charts I'm going to show you in a sec, they're a great value. Not only the charts, but all of the analytical abilities that the chart has built into it. Alternatively, if your account's big enough, if you do one 10-lot trade, let's say I buy one at the market, okay, I'm long 10 from 25.29, and I'm going to try to sell them here. If I get short, if I sell 10, then I'm flat, and that one trade constituted my 10-round turn commitment, or minimum. It's not a commitment. Don't make the trade unless you see it. I'm just trying to show you what 10-round turns mean. You could do three round turns in a 1-round turn, gives you 10, whatever math you want to use. All right, let's move that aside for now. Okay, so before I move on further here, I want to show you the charts. Let's see, did I miss some questions? Larry asks, is this being recorded? It is being recorded, Larry, and I hope to have it up on the Infinity YouTube channel shortly. Let me show you where that's at. All you need to do, this shortcut to get there is infinityfutures.com. Scroll to the bottom, click on the little YouTube icon on the bottom of the screen. The longer way to do it is type in infinityfutures.com youtube.com/infinityfutures. You don't need to have that user word in the middle there. And the YouTube channel is broken up into playlists to make it easier for you to find kind of whatever topic you're interested in. There's a search feature here on the YouTube channel. If you want to see all the playlists listed there, they're on there as well. So hopefully it's user friendly. There's a lot of stuff here. You can get lost in this YouTube channel. So I would focus on, trying to, and you can subscribe too. If you subscribe, then anytime we update a new video, and they're almost all free. They are all free. What am I talking about? You'll get an alert that says, hey, oh, see, this one's playing already, Jonathan Rose. You'll get it automatically. It's up to you. I don't care. That's how you find that. So we get a lot of questions about other competitive platforms, TradeStation, TD Ameritrade, and most of the questions, and not most of them, but a lot of the questions surround, and I'm going to use the word, how heavy the software is, and how heavy the charting is, and how that impacts your system resources, your computer resources. And this platform, our setup, let me pull the charts over so you guys could see that also, is the architecture is based on it being light. And I'm using the words heavy and light, and I understand that those aren't tech words, those aren't IT words, but I'm not a tech guy, I'm not an IT guy. I'm a futures trading enthusiast guy. And we want a light platform so that our PC processors, browsers, and all that other stuff could perform at a higher level of performance, minimizing data lag, trade execution times, stability, and all of that stuff. And we know who our competitors are. We know we've traded on these other platforms. We've analyzed these other. We understand it. We understand why the TD platform is super heavy and lags all the time. And again, if you're not, check it out. But that's my opinion, and that's based on my experience. So I hope that answers your question. That's my opinion. The best thing for you to do on that question, if you haven't downloaded this yet and you haven't tried it, try it for free for 30 days. The only cost for you for trying it is you're getting an email. You'll get another email from me with the username and password. I mean, that's the only cost. You're going to get an email immediately almost with a username and password and a link. And you download the platform and you install it, and you could set up the windows. Anybody here will be happy to set it up too. And so when you want to check for heaviness or performance or data feed streams, all that stuff, functionality of the charts, try it. Doesn't hurt. I will have somebody walk you through the setup if you want, at your convenience. So here's it. This is, this screen is a charting screen, right? This is just, I'm a simple guy. I like simple stuff, but you can get a lot of really complicated in these charts. And, I don't know if I like the light blue background, but I tried to make it so that we could see it a little better on a presentation format with GoToMeeting. And here's what I came up with. It's fully customizable. I'm just looking at my bond screen right now, and I simply have four screens. Monthly helps me identify trends. Daily helps me hone in on trends. 30-minute helps me understand trade entry ideas. And a market profile, which I'm going to go out on a limb and say is unique in futures trading. Anything with a deep bid-ask spread. I mean, this was made for futures trading market profile. And actually, that's, I think, a fact. But it really helps identify different areas where the market in general, which consists of you and me, retail traders, it consists of institutional traders. On the institutional side, there's two of them, right? There's the bona fide hedging people who are protecting their portfolios against the market going against them somewhere. Call those guys bona fide hedgers. Or the speculators. A hedge fund might be one. Trading firm, prop trading firm might be one. So market profile gives you a really good understanding of what does the market in general see in terms of what I call price happiness, and where does the rubber meet the road most of the time. And there's a whole class on this. I'm not going to get into it, but that's one of the powerful tools in trading futures. I think we have a couple of YouTube videos on this topic in among itself. Analysis tools, let's jump into them. I mean, we have I don't know if there's 300 of these indicators. Most of them are, a lot of them are, we pulled off the shelf. We didn't invent them. They've been standard technical analysis indicators for a long, long time, and they're all customizable, just about, so that you could tweak your MACD, you could tweak your moving average, you could add pivot points. That it's almost dangerous to have this much stuff on here because you can get lost in it. But once you decide on a good strategy, then you could, even before you decide on a good strategy, you could develop a good strategy with a practice account. Or if you have a live account, you could trade in simulated mode, right? So if you live account, you could trade in real mode or sim mode, and you could further refine your ideas, your trading ideas. So that's that. We have all sorts. You could trade from the charts if you want. You have many different tools you could have associated with retracements, Gann fans, all that stuff, drawing lines, pitchforks. The data is deep. So right now I'm loading 1,095 days data here on the daily bond chart. And so when I talk about that 1999 value, it's a huge data. Yeah, Scott, you could do back testing on here. Absolutely, you could do back testing. There's a lot of third-party plugins that you could add if that meets your interest. So the analysis tech tools are, I would say they range from basic to intense, and I'm closer to the basic kind of guy. I've been doing this a long time. I'm a basic kind of guy, but if you want to get really deep into the analytics and you want to do overlay charts and look at spread relationships and look at different types of ideas with respect to technical analysis, you could do it on here. These have come a long way. They went from average to great. And again, it's my opinion. Try them out. 30 days. Why not? Okay. Where are we at here? I think that's about covers it. Any questions I missed, type them in. And let me just see if I'm done with the PowerPoint. I think I am. Do want to remind everybody, trading futures options on futures and retail off-exchange foreign currency transactions involve substantial risk of loss, not suitable for all investors. Past performance is not indicative of future results. Let's talk about that for a second. Past performance not indicative of future results. When you go online and you do your research and you see performance being thrown around like a hot potato, be careful. There's a proper way to calculate and present past performance and hypothetical performance. And most of these ways require that the person that is posting it, if they're a commercial entity, are registered, regulated, or somehow covered in that sort of way. So buyer beware when you see, and it's all over. Let me show you how I made $3,000 in 20 minutes. Red flag on the field. Stay away from that. If you're not sure about somebody, call me and ask me. I'll give you my opinion. You don't have to take my opinion, but I'll give it to you. I'll be happy to give it to you. There's a lot of red flags out there, so be careful who you choose to follow and what you choose to do. We already talked about day trade margins, magnifying your risk. Be careful, double-edged sword. Go live, go to Infinity Futures. I think we're almost done here. Okay, this is an important thing I want to show you. Live trading challenge. Here's another kind of fun thing you could consider doing. And I'll put this screen back up here so you could have some more information. But the live trading challenge is one of our ideas. I don't know if it's a harebrained idea or it's a good idea, but in my opinion, it's a great idea. So every other month we have a challenge. You download the platform, You trade in simulated mode. It's free. And we give you real-time constraints. We don't let you go hog wild. We limit the amount of contracts you do. We limit your loss limit on any given day, and you trade for 5 days. And you get to, you get to practice for 5 days. You get to compete for 5 days. And if you make it to the leaderboard, which is actually updated every 10 minutes during the competition challenge, you make the leaderboard. And this is the finals of the August event. This is the final top 7 places. And you can see the net amount. And again, it's on a sim count, so this is a fake net, but the net amount that they made over the course of 5 days. And it was a lot of fun. And it gives you the ability to kind of really test real life conditions in a lower risk, a risk-free kind of free way to give you an idea of what you're getting into. So if you're interested, register. The registration's open. The next event's October 18th. It's out a little bit, but it's another way to practice. Don't let this interfere with your desire to do a regular simulated account here. You could do both. They're not mutually exclusive. So, Brad, thank you for that. I appreciate that comment. It's very nice of you. I appreciate. I'm not showing me the ES chart. The ES chart. Do I even have ES up here? ES. Yeah. So here's my ES chart. There's not a lot to look at. It's pretty simple. I got oscillator here, Keltner bands, and then I got the Brian Williams fractals going with the candle, a candlestick chart. So that's what it would look like. Howard, note level 3, but level 2 is sweet. That combined with market profile and some of the charts I showed you could be powerful. All right, I think I covered everything. All right, I'm going to count down on questions. Going once. Going twice. Oh, all right. Data fees. Jay, good question. Jay asks, how are data fees charged? For CME Group markets, you're charged basically $6 per exchange per month, up to a maximum of $18. And it gets a little weird because there's different exchanges within the CME Group. But the bottom line is you're not over $18. I mean, it's pretty bear with me, or it's pretty cost effective. So as an example, the CME Group has a couple exchanges under it, right? It has the old CME, it has the old CBOT, it has the COMEX and the NYMEX. And depending on which asset class you're in, it's a different exchange. So if you want E-mini S&Ps or Russell 2000 and Treasury bonds or Treasury notes, that's under the stock index futures category, and that's $6. If you wanted to add crude oil futures, then that's under the COMEX exchange, and that's another, or NYMEX, I'm sorry, NYMEX, COMEX, I always get those two mixed up, another $6. So you're at $12. And you want Chicago Board Trade, you want some agricultural futures, now you're another $6, $18. So the maximum is 18, as low as $6, depending on the markets that you would like to trade. So it's not very, that kind of data fee is not really a barrier for most people to decide to day trade or even to position trade. Each tick in a market is $12.50 or $10. I mean, 2 ticks and you're already past that easily. The same with the charts, 1995. I mean, that's 2 ticks in crude oil. So the fee barrier to entry here is very low. And again, it's my opinion. If the $6, I hate to say this, but if the $6 exchange fee per 30 days is too much, then this isn't for you. We're talking, leveraged instrument trading that it could be risky. Right, Jay, you got it. $6 to $18. So, in recap, a lot of opportunities here. Barrier to entry is low. You don't have to start out with a lot of leverage to start. A lot of people call me up and say, "Hey, I got a $5,000 account. How many contracts could I trade with the E-mini S&P? I want to know the max contract size." My general response is, well, have you traded futures before? Not. And depending on how that conversation goes, I'm going to give a different answer. If you haven't traded futures before, then you need to slow your roll and practice with 1 and 2 lots, no matter what your lot size is. If you have traded them before and you're experienced, then yeah, we can give you flexible day trade margins. We can give you a 10-lot trade on that because in theory, you understand the risk and you've gone through it before. You get it. So a lot of flexibility here, but also be careful. Be careful, be careful. We want you to last long. We want you to be successful. In any event, all right, so I think I got all the questions covered here. Last question. Andre asks, how much for stock index and currency futures? $6 for both of those. All right, I'm taking off here. I'm going to leave you with the contact screen, and I'm going to close this down in about 60 seconds here. I appreciate everybody coming today, and look forward to talking to you again.